So how does assignment work? Very simple. Right here, if the stock price is below our strike price expiration, we are going to be assigned 100 shares of that stock. Because remember, one option equals 100 shares. Options are leveraged. So what does that mean? Well, remember when we made this trade originally 30 days ago, the stock was at 100 bucks. But if it closes below $90 at expiration, anywhere below here, if it's $89.99, that's below 90, we're going to be assigned 100 shares of stock. And that's why it's important to realize that when we sell puts, we better do this in stocks that we like, because there's always the chance we could get assigned 100 shares of stock. We have to be ready to accept that stock. So we don't want to do this on a stock we don't like at all. But the rule is, if it's below our strike price at expiration, we will be assigned 100 shares of stock at that time. But the one beauty of being assigned, we don't ever want this to happen, but the one beauty of this is our cost basis is way down here at 85. Remember how we worked that out? All we did was take our strike price, which is 90, minus the credit received, which is $5, and that got us to our cost basis or break-even price of $85. So what does that actually mean to us? Well, let's say the stock closes below 90 at expiration. We're going to be assigned 100 shares of stock. But we're going to be assigned them at $85 per share. So as one example, let's say the stock closed at $88. What happens? Well, it's below 90. We're going to be assigned 100 shares of stock, but we're going to be assigned them at $85 per share. So even though the stock closed at 88, it looks bad for us. We're actually still at this point up $3 or a $300 profit on this trade. So we have 100 shares of stock, but we have them all the way down to $85. So the stock closed 88. We'll tell you what, we're still a winner on this trade. And that's why this is here, because anywhere in this area, anywhere between our cost basis and the strike price, we will be assigned stock, but we'll still be profitable. Because as long as it's above 85, even though we get assigned the shares, we're assigned 85. So anything above 85 at expiration, we're still a winner. So that's good to know. Assignment is not something we want, obviously, but if we do have it, it's going to be at a price usually pretty well below our strike price, or at least always below our strike price. Depends on the size of the stock, how far down you go, etc. But we have a cushion. So our strike price is our number for being fully profitable, but we have all the way down to the cost basis and above to still make profit on this trade. Only difference is below 90, we're going to be assigned 100 shares of stock.